forexbrokers.net, and this video is the beginning of a series of 3 videos dedicated to how to trade divergences with various oscillators. We will not cover, as the article in this Trading Academy shows, we will not cover everything related to divergences. I mean, every oscillator out there, but we will cover most of them, the most interesting and important ones, and we look at every aspect regarding divergences, mostly on the classic pattern, in the sense that the divergence is used to pick a top or a bottom, but also we look at that the divergences in a new fashion, in a new way, as continuation patterns, as you are about to find out soon. Now, in this first part, we deal with the relative strength index. This is the relative strength index on the with the 14 periods. Nothing changed here. As we've covered already in this academy, the relative strength index as an oscillator has an overbought level of 70 and oversold at 30. We edited a bit the oscillator a bit earlier by adding the 50 level. You will see why moving forward. There is the information on the article, but I will explain here a bit as well. And the idea or the standard interpretation when you trade with the relative strength index oscillator is that every time the market moves into overbought or above 70, that is an opportunity to sell, or every time it moves into oversold, that is an opportunity to buy. But as you can see, sometimes that is not the right interpretation, in the sense that, take a look here, the euro and Great Britain pound, the hourly chart here, the pair continues to drop while the relative strength index already reached oversold territory. So if you buy here, you only have to suffer all the way to the downside. As mentioned on the article dedicated to overbought and oversold areas, trading them makes sense when the market is in a range, when the market evolves in or when the trader can identify a range. But otherwise, it is useful to look for some reinforcements when it comes to taking the opposite side of the market, because here, if the market moves lower like this and you want to buy over sold level, it means you are a contrarian. For a contrarian, you need some more reinforcement for your trade, and that is a divergence. A divergence is defined as a difference, if you want, between what the price shows, the main window, and what the oscillator shows, the small window here. The price usually in a bearish trend forms a series of lower lows. So this is a low, this is a lower low, and the oscillator doesn't confirm the second lower low. The oscillator forms a low, doesn't confirm the second lower low, and that is when the market forms a bullish divergence. Why bullish divergence? The oscillator, the relative strength index, doesn't confirm the second lower low, and that's a right place to go on the long side. As mentioned in the article, and I invite you all to have a look, the condition or the way to trade these divergences with the RSI is not to go on the long side. For example, this is a bullish divergence, not to go on the long side the moment when the RSI goes back above the 30, or the moment when the price pushes and manages to form a green candlestick, even though in this case it was enough. But that's not the wisest thing to do, as often, as explained here, the market reverses and may stay in a divergent mode more than the trader remains solvent. So the key here is to wait for the market to push through the 50 level, and that 50 level acts as the middle ground, if you want, between 70 and 30, and by the time that it manages to go through the 50 level, that is the moment where trading to the upside goes. How do we trade to the upside in this case? Well, we define the risk, which is the difference from the entry place until the previous low. Ideally, in a bearish divergence or bullish divergence, the swing or the stop loss is at the top or at the bottom, as it is in this case. We measure this one projected on the right side 2 times, and that would be 1 to 2 risk reward ratio. Against aggressive traders go for 1 to 3, 1 to 4, 1 to 5, whatever. It depends very much on the risk appetite and risk profile of each and every trader. So the condition to go on the long side after a bullish divergence is for the price between the two lower lows of the price and between the divergence for the RSI to reverse more than 50%. This must happen. And then on the next move through the 50%, when the RSI manages to push through the 50%, that's the entry place, stop loss at the previous low, minimum 1 to 2 risk reward ratio. Here, the euro and the Great Britain pound, this is a scenario that intends to show what happens when the market remains in a divergent mode without the trading noticing. So if you ignore the rules, you may end up being trapped in such a strong bullish market when you actually go on the short side, and that's quite wrong. I mean, have a look at the price. The price goes and makes a new high here. The RSI follows and makes a new high. All good. All of a sudden, the price makes another high here, so a higher high. The RSI doesn't confirm that high. The RSI falls. The price goes and makes even a new higher high. The RSI falls even more. The price goes and makes a new higher high. The RSI falls even more. So while the RSI keeps falling, the price keeps rising. So the danger here is to go on the short side on here, believing that this is a divergence, and then if you are on the short side here, look at what the market did. Amazingly, get you out. So this happens if you do not respect the rules of how to trade the divergence. Do we have between the 2 points that mark the divergence, do we have the RSI going beyond the 50 level? No. The RSI here failed to break the 50, failed to break the 50 as well, and therefore this is no bearish divergence. For a bearish divergence to be in place here, you need what? You need the following. You need the market to go, if this would be one higher high and this would be another higher high, then you need the RSI to go and pierce through the 50 level. It didn't. How about here with this move here? Is this valid for a bearish divergence? I will take another line to illustrate. Well, it may be valid because the price here makes a new, actually it makes 3 higher highs, high, higher high, higher high, and then at the same time the RSI does not confirm that one. So if we consider these two, or like this, we see that the RSI reached the 50 level, and then it went through. So this would be a nice place to go on the short side. But remember what I told you here. Ideally, when you trade divergences, the classic divergences like this one, ideally the low or the high on the second point in the divergence should be that high at that time, and ideally it should be both of them should be in overbought or oversold levels. This is not in overbought level. This is already into the territory between 50 and 70. So this one should be disregarded as well, as it doesn't respect the conditions laid out here. Stay tuned for the second part of for the second video that comes to with this article, as we will discuss divergences with the Various Oscillator and with the MACD. Bye bye.